Good morning, and thanks for joining us here on Treasure Coast Solutions. Every Wednesday, we talk about things that happen economically, things that might impact you in your lives here in Stewart or in Florida. Some of the things that are taking place, or some of the things that might be happening that will have an impact on what you're looking to do. My name is Mark Brechbill. I'm a CPA. I'm also a ex-banker and have spent some time in the world of finance, be it what it is, and have had an opportunity to deal with some things that I find interesting, and I hope maybe there are things that you'll find interesting as well. Again, for those that are new to the show, it's not a financial planning show. We're not here to kind of give you some financial planning advice or talk about that. Although certainly we hopefully some of the things that we talk about will help you in your financial future. But generally, what we're doing is kind of talking a little bit about some of the things that happen economically and the effects that they have on us. Because the interesting thing about economics, and I know one of my friends, a guy that has been in this area, has been in the economics area for a long time, Merle Dimbath. Uh, he he has a PhD in economics. He knows way more about economics than I do. But the interesting thing is that in this area, you kind of, if you go down a certain path, you're going to get a certain result. It's kind of it's much more of a science than accounting, for example, which my background is a CPA. Accounting is very much more of an art than a science. It is not as precise as everybody thinks. There's a lot of estimates and assumptions and things like that come into the accounting world to determine what numbers are supposed to be put where, and even what's income and what's not. And things aren't as black and white as you would think, but they're also not as they're not as scientifically driven. In other words, you can't if you do something the same way in accounting, you won't always necessarily get the same answer. It depends on the interpretation by the CPA. In the case of economics, a lot of times it if you do the same thing, you're going to get the same result. It is a science. It can kind of be tested. Here we do this. This is the answer we're going to get. We do this. This is the answer we're going to get. But the thing that's confusing about economics is that um, it it doesn't always. There's a lot of in between stuff that happens, and that stuff gets really confusing. And people's interpretation of that can cause some intermediary type response that maybe is not anticipated, and can drive it. But on the global scale, on a large, what they call macro economic scale, uh, it doesn't really have, it all kind of flushes out. And if you do this, you do that. There are periods of time with anything, including economics, long periods of time. There can be long periods of time where you don't get your response. It is a delayed response. And most of us are the kind of people that like immediate response. So we look at something and we did this, and so immediately we think, oh, this is what's going to happen. Or we wait for the response and it doesn't happen. We say, well, that's not right. That didn't happen this time. But many times it is going to happen. It's just going to take a little longer. Um, so again, it's kind of an interesting thing with what we're talking about, because it does have an impact on what takes place. So uh, I know, for many of us, we we don't like that delay, and that delay causes confusion. But I would say that ultimately, uh, you're going to get your answer. It just may not happen as quickly as you want it to. So one of the things, though, that you do get a quick answer on, unfortunately, is is taxes. So I'm going to talk a little bit about that. I'm going to talk a little bit about that tonight when I'm on for Martin County Business Exchange. But but I thought I would talk a little bit about some of the stuff that was having an impact, and I also want to talk a little bit about some of the things that are going on from an economic standpoint that globally that are probably going to have an impact. Um, yeah, let's talk. A lot of times we talk about uh, trade, and there's trade. We talk about international trade, and the concept that is always argued about is the concept of free trade and tariffs. And you have a number of people that are currently opposed to the president's trade policies as it relates to the tariffs, and and that's understandable. Most because from an economic standpoint, tariffs uh, interfere with free trade, and and they cause, and what that does is it causes an improper allocation in a free market. It causes an improper allocation of resources, usually in the short run, because the market will correct itself. But again, like I just said, the short run could be 15 years or 12 years or 10 years or whatever. So a lot of times, just in general, people who are in more conservative and in favor of our capitalistic system. I won't say more conservative, that are in favor of the capitalistic system, are opposed to tariffs because tariffs interfere with free market. They interfere. That's why the federal government has the authority to regulate interstate trade, intrastate trade, interstate trade. I mean, not intra, trade between states. That's why the government has the ability to regulate that, because the founding fathers recognized that trade could allow one uh, colony, subsequently state, to dominate if they could charge whatever they wanted for tariffs and trade and taxes and things like that. So uh, so ultimately, the uh, that was a part of our original constitution, original system of capitalism. So a lot of people that are opposed to that process, to tariffs, is because of that, because of this concept of the limitation that it puts on free trade, and it redirects resources. We've seen that. Uh, now, when there were tariffs put on certain products from China, or from the U.S. sold into China, like agricultural products, things like that, the or steel or whatever it is, there's a reallocation of those resources. The places like China are going to buy. Um, they're going to buy those products somewhere else, so that it'll be cheaper, and so it shifts the resources over the long run. Um, Presumably, if that was going to stay that way over the long run, it could have a long-term impact on the markets. For example, China could allocate more resources to agriculture, and could start generating more of their own product internally. They could value that more over military or over whatever else that they're allocating resources to. Um, Other countries, third world countries, it could make it worthwhile for them to become competitors in that industry. Um, so, so what happens is when you put artificial barriers in the economic process, like tariffs and things like that, it forces a change in behavior. If you force that change in behavior over the long term, it will have an impact on that market uh, permanently. So if constantly our farmers here are faced with not being able to sell their product, um, they won't be able to make any money in the business. There'll be a consolidation within the business, which there already has been. Ag is already dominated by large corporate farms. So there'll be a consolidation in that industry even further, to the point that eventually either the competitors won't be there, so that there won't be, so price will be there won't be any fair market prices. Right now, there are enough farmers that prices tend to fluctuate and reach equilibrium, but which is considered to be fair price. But what would happen is that there would not be that, and they would try to regulate their side of the market, either by dealing with other customers, charging a higher price to those customers, or ultimately moving out of the United States. Uh, if ultimately it becomes, there's no tariff if you're growing somewhere else, you might move your farm to the Dominican or someplace where you can produce that cheaper. Uh, and that is the problem with tariffs and subsidies, is that they interfere with the market. Take sugar, for example. One of the reasons sugar is produced here in Florida is because of subsidies. If those subsidies went away, it is much cheaper for Florida Crystal and U.S. Sugar to produce their crops in the islands or in the Caribbean or someplace else where the costs and labor are cheaper, the environmental issues are cheaper. For example, down in the Dominican, you don't have the restrictions on emissions on their tractors. They don't have the restrictions on the runoff from their fields and from fertilizer and those kind of things. They don't have those kind of requirements. Now, there's a cost factor to making sure they maintain those. It's profitable for them not to waste fertilizer and not to waste um, the process of water and everything else, because like anything, those resources are limited and they're expensive to extract. Um, but from a purely government standpoint, they face a lot less government regulation, which means there's a lot less cost on their end. They have more freedom to uh, to try to maximize profits, which is what capitalism is about, to maximize profits and minimize expenses and losses. So, bottom line is that's the advantage of, and so in the long run, they would make that move. For example, in the United States right now, if that crop was not subsidized, it would not make sense to plant um, sugarcane. It just wouldn't. It probably there would be no money in it. There'd be too much risk, very little money for the amount for what they have to do there. Land is expensive in the United States versus other places, even out in the Everglades. So in all of the, you look at when you look at trade, you have to look at those kind of things, because subsidies and tariffs cause issues. From an international standpoint, um, international free trade agreements and other things prohibit countries from subsidizing certain businesses or products at the detriment of another country. So, if, for example, as a CPA and taxes, I deal with this. Um, we had a provision that was in the was put through on the tax laws to provide some sort of there was an excise tax that was being proposed on certain international products, and the European Union and others felt that was in effect a disguised subsidy. Because of the excise tax, we were subsidizing that particular industry, and so they basically said that they would counter that with excise taxes or charges if we didn't back off. And what they said is that you can't have, in their opinion, and that's what counted, because they were the ones that were going to counter the excise taxes and declare them to be illegal internationally. Is that you can't have that kind of you couldn't have a tax or a benefit that just affected international support of companies in the international markets. It was considered in effect to be a subsidy, even though it wasn't directly connected as such. So a number of years back, the government changed the way they handled that, and they put into effect. It's called Section 199 in the code, and it's actually what the Trump administration has utilized. They've created Section 199A, which is a variance of this same procedure that allows that is our tax structure today to get your tax rate reduced to basically 29%. Um, and it was a way that they did that. They did that through the mechanism that was created previously to address international issues, and that was this domestic production activities deduction, is what it was called. And the key word there was domestic. So it was something that had to apply to domestic companies as well as international. Now, the original one was set up based on production and based on the basically manufacture and production. It was a way that and it was implemented, I think, in the Bush administration or the Obama administration. It's been in play for a while. I think it was the Bush administration, and it was designed originally to try to make international manufacturing companies and production companies more competitive price wise, primarily with China, who in effect subsidizes all of their businesses because all of their businesses are government owned. So China subsidizes. Funny thing is, the World Trade Organization has never come down on China for this because they can't. They're not powerful enough, I guess. But China has always subsidized the businesses that they want to subsidize by because they control all of the resources of production. If you're a government and you control all the resources of production, i.e., you're a communist or socialist nation, but a communist nation, you control those. So you can say, okay, here's a 16-year-old boy. I want you to go out and I'm going to put you in charge of, or put you out and let you work in the fields as a farmer. And you're going to do all this stuff by hand. But I'm going to take this 16-year-old boy and you're going to go work for this steel plant. And I'm going to pay you more to work for the steel plant than I'm going to pay you and give you more benefits. I'm not going to pay you more because, frankly, it's communism. It's all equal. But you're going to get a lot more things, because you're going to have better living conditions and better meals and things like that than the farm person will. So, in effect, what's happening is everybody would choose to work for the manufacturer. Nobody would choose to work for the farmer in China if they were given a choice based on what the outcome is. But the government says you're going to do this. And so as a result, they reallocate those resources not based on price, not based on the competitiveness of the industry, but rather based on what the government wants to focus on. We want to produce steel at a low cost. So you guys are going to I'm going to put a bunch of people here producing steel. Agriculture, we don't care about. So we don't care if it's inefficient and it's produced at a high cost, especially a high labor cost, because we have to have people doing something. So we'll have them do this. So, it's interesting because that again, that's the way China can control all of the resources. They can control the price. So China has always been doing that, but the World Trade Organization said to the Bush administration at the time, you can't do that. So that we came up with this domestic deduction that even domestic companies were eligible for. It wasn't just foreign companies. It was any company that was under the U.S. tax code. So as a result, Starbucks was eligible, and because grinding the beans was considered production, and so was a couple other entities. McDonald's couldn't convince them that flipping the burgers was a production activity, so they didn't get it. But construction, and that's the big thing. All of our construction businesses, that's considered production. So they were eligible and still are for this credit, and they got it based on how many, what their material costs were and what their labor costs, particularly their labor costs. It was based on how much labor they hired. Anyway, so those are the kind of things that have to be done ultimately. And on the international level, it appears more complicated because of the fact that There are just there are more pieces, more players, and because not every aspect of the financial market, I mean, the international market is competitive, has any form of capitalism, i.e., China, Venezuela, Cuba. None of those places have anything close to a free market system. So, therefore, when they compete, when their businesses, which are government owned, compete, it is the government. So, if that government decides to create a job that encouraged people to go to work in the manufacturing area, or discourage people to go to work from the manufacturing area, and how much they're going to be paid for doing that determines the price of that product, at least on paper. um, but but they don't care, because from their standpoint, they're not looking at an individual industry, they're looking at the country as a whole. And so what they're looking at is they're saying, okay, we've got these resources that we want to sell in the international market. What resources do we have the ability to make the most money out of? And particularly if we are the most competitive. So, for example, if they can be the cheapest cost for steel and the cheapest cost, because they can, because their labor costs are so low. If they and their labor costs are low because they don't have to pay their people anything. They tell their people what to expect, what they get in food, what they get. They eliminate a lot of the expectations, of course, except in the political arena where the Communist Party has a lot of perks. But in general, the average person there doesn't receive a lot of benefits. And as a result of that, let's face it, China doesn't really care about healthcare. The more people that die, the less people they have to deal with. They have a large overpopulation problem. Death is not an issue for them. That's why, you can bet that this flu virus has been around for a little while. They just had it contained to an area that doesn't have a lot of traffic, and probably they weren't concerned that, a few thousand people might die. That's not a big number for them. That's part of their healthcare program. Some people get benefits, some people don't. And I'm sure in this case, a lot of people weren't. It wasn't an issue. Now that it's becoming an international issue, it's going to affect their trade, and certainly they're going to address it. Not because they care about their people dying from the flu, which is why we're addressing it. They're addressing it because they care about the fact that it's going to affect their ability to sell other products and make income for the country. Uh, if their businesses can't transact business internationally because they're not allowed to leave China, it's going to definitely affect their economic results in their country. And again, it doesn't make any difference what your company makes, because all of that is in effect owned by the government. Even the Chinese government itself has a partnership in virtually every business that's over there in some form or another. And that partnership allows them to extract profits uh, or technology out of everything you do. So if you make money over there, you can bet at least half of the money you make, if you're a U.S. company, about half the money you make is going to go to the Chinese government in some form or another. It's probably going to go to a province. It's going to go to a local thing. So it's not going directly to the China, but it goes into the government offices in that area to fund the jobs in that area and to pay for other work that's being done. So it's basically money that's going to the government to be reallocated from a profitable business that's taking money internationally and bringing it into the country to people that need that money, or need that those benefits internally, and they're reallocated. And based on how profitable that is, basically determines what kind of benefits are available for distribution in that particular province. So so don't be fooled. China isn't concerned about this plague, in effect, that's is flu that's coming. They're not concerned about it because of the effect it's having on their people. They're concerned about it for the exact effect that it just had on the U.S. stock market. Um, they the U.S. stock market recognizes that trade with China is important, and if it's cut off, it's going to affect the economic results of companies in the United States. So those companies' earnings won't be what were originally projected, which causes their stock price to go down. And that's what impacted the stock price. When the market settles down and people ultimately realize that flu is not going to shut down the world and it's not going to affect long-term profits. It might have an impact in the short run, the next 6 months or a year, but it's not going to impact what happens in the markets on the long run. Because why? People don't change behavior because of flu. Now, if it turns out that there's something going on in China, that this flu was always going to be there and was always going to be around and that we could never get rid of it and we weren't going to get through it, then yeah, that would be a problem. And probably people would then stop permanently doing business with China, and it would have an impact on China. But that's not going to happen. So over the next year or two, like I said, in economics, the horizon is long term. So in the short run, there is really no reason to react to the flu as it relates to the stock market. That's just people being dumb. That's people being trying to figure out, you know, where they can make a short-term profit. But if I own Apple, Apple has a big, has a presence in China. I'm not gonna sell Apple. Apple's not going to go out of business, and Apple's not going to lose the Chinese business for the rest of the time. Um, so, it's ridiculous that the market has dropped, and I'm sure the market's coming back. Will come back in short run because eventually everybody will realize that the flu doesn't last for years. It only lasts for a relatively short period of time. So any impact it's going to have is going to be short lived. So anyway, that's the kind of thing that when you look at it from a global basis, you can kind of get above. And like I said, I don't provide financial planning, but and I'm never going to tell you what stocks to buy and not buy. But when you look at things from an overall standpoint and over a long term, you start realizing that some of the things that the market reacts to in the United States is not necessarily something that it should react to. It's kind of like when the doctor hits your kneecap with a hammer. There's an immediate jerk reaction, and you get a response, but it's not a continual response unless you keep doing it over and over again. This is the same thing. Immediately a bunch of jerks have a reaction, which causes the price of the stock to change, and then they all come to their senses and realize that, oh, I'm not going to have the flu for the rest of my life, so therefore maybe this will be a short episode and nothing long term. And then they go back to trying to figure out what the next major crisis is going to be. Um, the Now, if I was looking at something, that might have an impact, I would be probably, if I'm a stock market person and I'm looking at economic indicators and economic issues and trying to relate where there might be a subsequent problem in a situation. um, I might be more concerned about what's going to happen, what's happening with the president, because let's face it, a lot of the economic growth we've had in the short run here is been as a result of the president's tax policy, his trade policy, his economic policy, and that has produced a significant amount of jobs, and it's started to result in a shifting of those jobs. And so some of the stocks that typically in the past we wouldn't have invested in, manufacturing stocks, which were not U.S. based or were losing their U.S. footing, are starting to come back. Some of the production activities are starting to come back to the U.S. So if I'm counting on that, and I've got a certain group of stocks that I'm buying based on the fact that their tax rates are lower and so their costs have gone down and they're going to be more competitive internationally and they're going to sell more products overseas and it's going to make more sense for them to be located in the US. So they're going to create more jobs here, which is going to create more ability to buy product in the United States. Then I might start looking at that and say, okay, what's going to get hit the hardest if Trump's not reelected? And and I might make an adjustment there, if that's the case. Because there are certain stocks I probably want to dump, um, particularly ones that have previously not been competitive with if it weren't for the tariffs and other things that are supporting them right now to reshift that behavior, that buying behavior or selling behavior. So anyway, um, like I say, it's kind of interesting how all of that plays out, and when you start looking at it and stop, and don't even let's face it. Uh, there's definitely an economic impact, a short-term economic impact, depending upon who's the president and what their policies are, who's in Congress and what their policies are, and who's on the Supreme Court and what their policies are. But the issue is more long term. And long term is even longer than 8 years if a person serves 8 years. I mean, you'd still have to be concerned about what is this a permanent change in behavior? Are we always going to do it this way? Are we always going to tax this way? Are we always going to do this way? Or is this just a short run reallocation of resources? Um, if I'm a business and my tax costs go down, it gives me the ability to, you know, either raise my material costs, which there's probably no reason to do that. Unless I'm going to use better quality materials, which is maybe going to get me a higher price, which ultimately means I make more money, or I can increase my labor costs, which mean raises. It may mean productivity increases. It may be hiring a bigger workforce as I expand, so that I've now got more people especially in service industries, more people to produce my product, or provide my service. So all of those things are going to have an impact. The question is whether they'll be permanent or we'll go back to the point where they're not. And to the extent, especially as it relates to the labor component there, the production component, materials component is important, but to the extent that the labor component gets bigger, that means that people in the U.S. have more ability to buy product, which means that most of the U.S. companies will do better, because there are still a large portion of our U.S. business environment that is local, is not international. As much as we've tapped the international market to some degree, it's not as tapped as the big Wall Street firms are. So anyway, it's that's why I say it's even some of these things I wouldn't you know there's reasons to pay attention, because in the short run it can still cost you a lot of money. You can still go out of business if you don't recognize the problem. So I'm not saying you need to ignore it, but when you're making permanent decisions or decisions you need to look at overall what's going to be the economic impact. That's why, and until such time as the tax act that was passed in 2017 and was basically implemented in 18, that goes to 2025. There's a large portion of that as long as there's an end date on it, we're going to always have problems. We're not going to get a permanent change in behavior. I'm not going to do anything that the only benefit I get is between now and 2025, if that involves spending a lot of money based on future revenue that's going to be long term. In other words, if I'm going to build 6 new manufacturing plants, if I'm General Motors and I'm going to build 6 new manufacturing plants in the United States instead of building them internationally, I'm going to incur a significant cost. It's going to take me a while to get those plants up and running. So about the time I'm going to do that, let's say 2025, all these tax changes, my tax breaks go away, my costs are higher, my employment costs are higher, all of that. Well, I'm not going to make the money that I need to make to recoup those costs, because I need this to be a permanent solution. I need this to be a long term. And by permanent, I'm talking 15 years, 20 years, something that becomes more ingrained in our economic environment in the United States. So I need that to happen. And if I've got an end date on this stuff, 2025, I'm not going to get the behavior and do the things that the government wants you to do while there's an end date on that. I may take advantage of some of the things in the short run, but I'm not going to do anything that's going to cost me money in the long run that I'm not going to recoup in the short run. so, I may take my profits and reinvest them, but I'm not going to go out and before I make the profit, spend a lot of money. It's the same thing right now with with the Tax Act. One of the things that went into play and is implemented is that the unified credit amount, they call it, that in the estate and trust world, that's equated to a dollar amount of assets that you can have at your death and not pay tax. You in effect are paying tax, but you're giving a credit to offset the tax, so you don't actually have to pay anything. That number at one point used to be about $650,000. Not that long ago. I mean, in my time as a CPA, I've been in business now about 25 years in public practice. It was that when I started in public practice in the 90s, it was like 675, 650, somewhere in that range. It was a very low amount. Might even have been a little lower than that. Well, effective as of now, it's $11.5 million roughly. And really it's closer to $23 million. And why do I say that? Well, because if I'm married and I have a spouse, even if they don't have any assets, if I have an estate that's, let's say, $22 million, well, that's above the 11 and a half. So you'd say, well, in the old days, I'd pay tax on that. But what happens is that I can give that to my spouse, whatever I haven't already given away and used up, I can give to my spouse when I die, and they get to take with them whatever I haven't used up. So let's take it the other way around. Let's say that the spouse, let's say your wife dies. Let's say that your husband dies and the wife has all the assets. I hate to be sexist. So let's say that the wife has all the assets, the husband has none. So the husband dies and hasn't used any of their unified credit, their $11.5 million. Well, there's portability. So it goes to the wife who has all the assets. Now she's got $22 million worth of assets, but she's got a unified credit now that's $23 million. So she still isn't going to pay any tax on her assets, even though they were all her assets and they were $23 million. So it's because of that portability. That portability was added to the tax law, probably about 7, 8, 9, 10 years ago. And it, in effect, doubled the amount of money that a married couple can transfer. Frankly, I have known people who have gotten married solely to take advantage of that. And you can gift that out to kids, and you can, do some of those kind of things as well. So, which is not quite as good as having it in your estate and not paying any tax on it. When you gift it out, any income is going to be taxed to your kids or to whoever you gift it to. They're going to pay the income tax when they sell the asset. But at least you've gotten it out of your estate for estate tax purposes, which actually has changed the way people think a little bit about estate. It used to be that you would get it out of your estate so that you wouldn't have to pay the estate tax, because the estate tax was like a 50% tax. So you'd get it out, and then as to somebody, especially an asset that was appreciating in value, and then as that asset appreciated in value, then it would go to the increase in value would go in the name of the kids or somebody that you gifted it to, and they wouldn't have to pay tax at estate rates. They would pay it at income tax rates, which were below 50% during most of that time, and so they would be able to to pay less taxes in total. The disadvantage of it is you were actually gifting out a tax liability. So if you had a $5 million asset and you were getting it out of your estate, and let's say you paid $1 million for that asset, you got a $4 million gain. When you gift it out at $5 million, but your daughter picks it up as a $5 million value, but a $1 million cost. So if they were to turn right around and sell that asset immediately right away and turn it into cash, they would have a $4 million income tax liability, or $4 million of income that they would have to pay tax on at whatever the current rates were. If those rates were 30%, they're paying $1.2 million in taxes. So the government's still getting a lot of taxes. They're just not getting 50%. So it was one of those kind of things where you're gifting out the tax liability. So you get in a situation, and I've seen this happen. I have clients that have been gifted over the years, have been gifted stock in major corporations. Procter and Gamble, for example. I got a client whose family was some of the original money behind Procter and Gamble. So they have shares of stock that has been gifted to them, that has a cost basis of about 99 cents a share. Now go look and see what Procter and Gamble is selling at, and you can see what kind of gain. It's to the point that they can't really afford to sell that stock to generate cash to live off of, because of the income tax will be so high. They'll be paying so much in taxes on that. So they liquidate other things, even though from a financial planning standpoint, it would have made more sense for them to liquidate the Procter and Gamble stock, because it would give them some diversification. They could, now they've got a big exposure to Procter and Gamble stock in one industry, one company. So, but over the years, it was one of those kind of things. It was kind of funny. It used to always be the deathbed comment was, "Don't sell P&G." But anyway, so that's how, when you have an impact like this. So we've got this increase, and some people right now, because of this, they're looking at actually making in effect, a counterproductive decision if the tax law were to stay the same. If the tax law stays the same right now, and you have a $5 million or a $10 million, let's say you have a $15 million company. You got a $15 million company, and you're in your 50s. So at some point you're going to stop working, but you're in your 50s right now, and so you're going to continue to work. You're going to still run the company. You don't want to sell it yet, and frankly, you don't want to turn over control of it to your kids yet. You're not ready to do that yet. So you're in your 50s. You're looking at this corporation that you own, and it's, like I say, it's worth $15 million, and you're saying, well, what do I do? Well, what would make sense for you to do is to keep, if the company was going to stay under the 15 or under the 22 million in the next 10 years, it would make sense or 20 years or whatever it is, it would make sense for you to hold on to that stock, and keep it as stock in case you passed away, and then at that point you'd get stepped up basis. Your family would get stepped up basis, and they wouldn't pay any income tax, because you know what, that $15 million business, your basis in it is probably $1 million or less over the years. So it would make sense now, where the tax laws are, for many, many small businesses or smaller businesses, $5-7 million businesses, to hold the stock in those businesses until they die, and then their kids will inherit the company tax-free. And it will be truly tax-free. No income tax, no estate tax. But what a lot of people are saying, and rightfully so, is, well, but what happens after 2025 when this goes away? If I haven't gifted this out, that estate tax, that credit might go down to the equivalent of $3 million or $2 million, or someplace where it was before, or $5 million where it was before. Well, now if I've got a $7 million company, and I die with that $7 million company, and the limit's $5 million, I'm going to pay 50% of anything over the $5 million in estate taxes. So not only am I not going to pass it out tax-free, I'm going to pass it out at a much higher estate cost than I would have passed it out at. So that's the kind of thing that we're talking about right now. That's why a lot of tax policy has to be longer term. The fact that some of this stuff is expiring in 2025, it is very hard to plan for that, because you don't know. And if I was looking at trying to bring manufacturing back into the United States, frankly, I wouldn't do that if I'm a major company, because I'm not sure that it's going to be to my benefit. If I bring manufacturing into the United States and it was over in another country someplace where the tax rates were lower, and I bring it into the United States because right now the tax rates are low, but what happens 10 years from now when the tax rates are double or triple? Or based on some of the discussions that we're hearing about from some of the Democrat candidates about taxing major corporations, and why would I come here and pay that tax if I'm paying no tax in Ireland, for example, and I'm a pharmaceutical company, or that type of thing? So why would I do that? Well, I wouldn't. It doesn't make sense. So I have to know, if I'm going to make long-term economic decisions, I have to know, have a general idea of what long-term tax policy is going to be and what long-term costs are going to be, environmental costs, regulatory costs, labor costs. I have to know in the long run how those are going to be compared to other countries. And until you have a permanent shift in that, you're never going to have, we're not going to bring some of these jobs back to the U.S. They're just not going to come because they're going to also have to deal with the tax consequences of that. And again, right now, until it goes away in the U.S., if you're a U.S.-based company, if you're a U.S.-based individual, you're going to pay tax on worldwide income, regardless of where you make that money. Whereas if I live someplace else, if I live in, let's say, Ireland, I'm not going to pay tax on worldwide income. I'm going to only pay tax on the income I make in Ireland. And in fact, if that income is royalty income from the lease or sale of patents, I'm not going to pay any tax because Ireland exempts that from tax. That's why all the pharmaceutical companies are there. They go there, they charge all their research and development through Ireland. They then turn around and charge royalty fees to the United States and to other places. That creates a loss in the United States by paying those royalty fees. It pays income in Ireland for those royalty fees, but Ireland doesn't tax those royalty fees. So what have I done? I've extracted income from the United States by charging these high prices, and I've pushed it over into Ireland, where I pay no tax. So that's pretty smart, and that's the obligation of the company to do that. Their job is to maximize the profit to their shareholders. That profit is after everything. It's after labor, it's after materials, it's after taxes. Taxes are a cost. They are not, there are nothing more than that. So, a corporation has to produce a certain return on investment, a certain net profit, and it has all of those costs. So if one cost goes up, then you can't just reduce your profit, because that means your company will go out of business. You won't be able to sell your stock. You have to reduce some other cost. If, on the other hand, you reduce one cost, it means that you will potentially increase another cost, or you will get more stock, which will give you more money to expand your business, which in the long run will increase your costs. But it will also create more jobs, create more product sales, and all those kind of things. So anyway, that's what we're talking about. So the tax changes are really important. Next week, I'm going to talk a little bit about some of those tax changes and some of the things that you might need to know, and we'll discuss some of those things here on the show. And as always, if you have any kind of comments or questions, you can always call into the show, 220-9788, 220-WSTU. Write those numbers down. Keep it for future reference, because that's a good number to call in here for most everything here on WSTU Digital 1450. We are Martin County's Heritage Station.